Thank you, John. I do not have a coat on because I walked out of my office without it. So I'm not typically this informal, but at least for presentations like this. But I want to welcome everybody. Thank you for coming out. I was asked by a couple folks for ASFIP going back probably 9 months ago now to give a talk in December, and I agreed to do that. And then until about 3 weeks ago, I had forgotten I had agreed to it. And so when I got back in touch, I realized that there probably is more information that you would like to hear about real estate industry and REITs than there is about Piedmont. To the extent you're interested in Piedmont, I've got some information here that I'm going to walk you through. But to the extent you're interested in investing in the company, we're right here in Atlanta. We'd be glad to either set up a conference call or get together with some of you if you have further interest in the company. But I think hopefully some of my comments today would be more helpful to you as it relates to how REITs fit in portfolios and how real estate may be beneficial to be thinking about from your perspective. So let me take that as my goal here and see if we can do this. Is it impossible to see from back there? This particular slide, I think this is the busiest slide I've got, but the point I'm trying to make is back in 1960, REITs were introduced through legislation signed by President Eisenhower that created, the purpose of them to be created so that small investors could get access to real estate investing in smaller increments. The REIT format itself, the most important thing you need to know is REITs need to distribute at least 90% of their taxable income to investors to maintain basically a tax-exempt status. If they do that, then those dividends are taxed at an ordinary income rate to the investor. Of course, some of that dividend is protected because much of the dividend that's distributed from publicly traded REITs today is a return of capital. So, and this would be a little bit of a stretch example, but last year over 50% of Piedmont's dividend was actually a return of capital, and so the taxable impact was far less than you might have expected. And that depends on the company and where they are in their life cycle and how much product they're selling and things like that. Depends on how much they're distributing, or how much is taxable on the distribution. But the point is the tax effective yield is actually much higher than you might otherwise think. So let me see if I can, here we go. So let me see if I can break the slide down for you. REITs today, there's about 225 REITs in total, 184 of which are what we call equity REITs. Equity REITs and mortgage REITs are very different instruments. Mortgage REITs are really just leveraged finance vehicles. Equity REITs are ownership of real estate in the industry. So there's 225 companies in total, about 184 of those are equity REITs. So we're talking about 184 company universe to invest in, with about just under $1 trillion of equity market capital. So the industry's grown dramatically in the last 25 years. REITs pay about a 4.3% dividend on average across the 225 companies. And there's a number of things happening in the industry I'm going to talk about in a moment that ought to be sort of important to you. Among them, the fact that REITs are getting more and more included in the S&P 500, so they're becoming a much more investable asset class. And maybe most importantly, as of August 16, REITs are going to be separated out of the financials asset class in their GICS codes and create their own separate asset class. Now, mortgage REITs, because of the nature of the product class, are going to stay in financials, but equity REITs and other real estate companies are going to be coming into their own asset class within the equity indices. That's a really important aspect of things I'm going to talk about a little bit more in a moment. Sorry, I got to point out here. So let's talk about hot topics in the REIT world for a second if we can. And eventually I'll figure this out. So there's sort of three or four things going on that are particularly important in real estate right now. One is most of you who don't follow REITs very closely probably are wondering, why would I want to invest in a dividend stock today, particularly with the threat of rising interest rates? I'm going to talk about that a little bit. I'm going to talk about the fact that private real estate values and public real estate values have become sort of disconnected from each other. So I'll give you a little bit of a flavor of why that's the case and what that means to you. The fact that there's a fair amount of activism starting to come into the real estate space where historically we hadn't seen it. I'll talk about that for a moment. And then I've already mentioned the SIC codes. I'll give you a little bit more perspective on that as well. Okay, so long term, real estate or REIT indices really got started in earnest in about 1992. So from 1960, when the original tax law was passed that created REITs, till about 1992, the REIT industry was really just populated with a handful of fairly small companies. There's a couple that are still around today, like Weingarten Realty out of Houston, Texas, and a few others that were around in the 80s. But basically, until late 1992, and you can imagine what was happening at that point in time, we were coming out of the recession of the late 80s, early 90s, and real estate was heavily over-leveraged. And so a number of large companies that were in the private real estate space were looking for ways to recapitalize their companies, and the public REIT vehicle became the vehicle of choice. So literally hundreds of publicly traded REITs became public in the early to mid 1990s, and as a result started driving an investable asset class that heretofore hadn't been around. Since really the mid 90s, which is the 20-year number that I've got on here, REITs have actually substantially outperformed the S&P 500. It's been a great asset class. The last 10 years, not quite so great as a result of the fact that we had the downturn in 08, 09, which more punished real estate than it did some of the other asset classes. And then more recently, we've struggled to overcome this concern that rising interest rates are going to really beat up the REIT asset class. And again, I'm going to talk more about that in a moment. The interest rate correlation to REITs is an interesting one, and I don't know that anybody has the answer, but it's a fascinating thing to watch as a REIT CEO who sort of pays a lot of attention to why certain return aggregation is happening within our portfolio. In the last few years, we've seen a lot of volatility in the REIT sector as a result of, especially when interest rates are moving up on an unanticipated basis. So what ends up happening is you'll get a comment from the Fed, or you'll have something happen where the 10-year bops up 10 or 15 basis points in a day, and REITs get hammered really quickly and really fast. And as a REIT practitioner, you're thinking there's no rational, that's not a rational response from our perspective of what's happening, certainly within your company. The only thing you can explain it is people are afraid that obviously that dividend yield component, which is a very small component of our investor base, because our investor base is about 10 or 15% retail investors, 85 to 90% institutional investors. The institutional investors couldn't care if I pay 0 dividend or a 6 dividend. All they care about is my total return. And so it's a very small component of my investor base even cares about the dividend, and yet REITs get hammered when there's unanticipated expected interest rate rise. So what you've seen is very high correlations on short-term bases and a much lower correlation on long-term bases to interest rate rises over periods of time. And so it's going to be interesting to see sort of what happens this time, but what I would tell you is, let me ask you a question. Who thinks the 10-year in this room is going to be above 3.5 by the end of 16? 3%? I mean, that's a pretty typical response. Very, very few people think you're going to be over 3%. I'll tell you right now, as a real estate guy, there's so much spread compression built in to borrowing rates, and some of the bankers in the room will tell you that, that in my opinion, our cost of capital from a borrowing standpoint doesn't change until interest rates get at least into the 3s, and maybe even to the high 3s. Our cost of capital doesn't change much. So unless you think interest rates are going up dramatically over a period of time, there's no real impact to our fundamental businesses. The only thing you're seeing is a reaction because people think there's a fundamental impact. And so if you believe that interest rates are going up, you ought to stay away from the REIT sector. Much larger than that, you ought to stay away. If not, you ought to really be paying attention to it. Yeah?
I don't know if you want to take questions together, but on that particular topic, for a typical REIT, what is the duration of their fixed income financing? Is it short term, so they're having to roll it over, or is it longer term, so they're actually benefited?
It's all over the board, but very much like broader corporate America in the last few years, the REIT management teams have done a pretty good job of extending out their maturities pretty dramatically because borrowing rates have been so low and cost of capital has been so good for longer term pieces of paper that I would say duration is fairly long now. I don't know what the exact number is, but I would say it's probably longer than we've seen it in a very long time. Now that doesn't mean that you couldn't get 3 or 4 years down the road and have some of that paper starting to come due, and then we hit into a cycle where rates are going up. But I think for the foreseeable future anyway, there's very few problems on the horizon, even if we did see a dramatic rate hike. And by the way, there is also a handful of companies that are probably financing too much floating rate debt and things, but those are that's the minority, not the majority. So here's the interesting aspect of what's happening as a result of everyone's perception that interest rates are going to be causing REITs to struggle. And what this slide shows you from basically left to right is a series of sectors in the REIT marketplace, from storage, manufactured housing, net lease, data centers, that are trading at pretty big premiums to the underlying values of their company, the real estate values of the company, over to a number of the more traditional asset classes like office, regional malls, and hotels that are trading at dramatic discounts to net asset value. And it's probably not that important to get into why certain sectors are doing better than others, other than it's just sort of perceived growth and things like that. But what's fascinating is how big those discounts are. Those are almost historically wide discounts that you're seeing in certain sectors of the market, my sector included, on the office side, where it's very hard to make any sense out of it unless you're expecting, which is the title of the slide, unless you're expecting a value decline on the private real estate market side. And that's why I asked you the question of what do you think is happening with interest rates? Because unless you see interest rates going up 3.5%, 4%, it's very hard to see where real estate values are going to be coming down, particularly because fundamentals are so good in so many of these sectors. I mean, our portfolios are all well leased. There's not a lot of new construction coming online with the exception of a handful of markets. And as a result, fundamentals probably going to stay very strong for the foreseeable future, absent a big decline in the economy. Well, there's a big decline in the economy, interest rates are probably coming back down, so the whole reason you were concerned about REITs to begin with probably didn't have a lot of merit. So it's a very interesting time in our marketplace, and as a result, it's one that it's a great time to tell the story of why REITs people should be paying attention to them. I mentioned the activism is on the rise, and I won't spend a lot of time talking about this. I'm not sure it has a lot of application for a group like this, other than to know that for a long time, because REITs have structural limitations on how much ownership people can have in the REIT. There's a maximum number of a minimum number of shareholders. There's a maximum amount of shares a particular holder can hold. And as a result, that makes it very hard for people to make plays on companies. But until recently, what's happened with a number of companies that have been sort of structurally broken, if you will, or there's been management teams that haven't had interests aligned properly, it's been very hard to get much in the way of activism done. That's started to change more recently, and as a result, I think it's brought even more discipline to the sector, which I think is great overall for the sector. Okay, let's dig into the SIC code issue a little bit more. This is one that's really, I think, probably the most pertinent issue from your perspective. We've known this is coming for some time now, and what it really is going to drive, I think, is a number of changes to how people look at investing in real estate. So if you're a young analyst in the equity business and you want to see a sector that I think is going to have great job growth in your sector, it's going to be the REIT analyst community. And the reason I say that is there's a lot of people out there, a lot of generalist shops who don't have anybody who specializes in real estate in their product class or in their office. And as a result, they're trying to cover real estate under the financial sector. And it's such a unique asset class, and the guys from REMS will be the first to tell you, it just requires a specialty expertise to really understand what you're doing in the space. And as a result, I think there's going to be a lot of people hired into the space because you're going to sort of have to pay attention to the sector, or by definition, you're making a call away from the sector, and you're going to be held to account for it. So Cohen & Steers, who's the largest REIT manager in the country, put out a little piece recently that I borrowed some of that from, which is basically showing that in the current GIC sectors, you can see that under financials are REITs and other real estate entities. And what's going to happen as of August of 16 is the mortgage REITs are going to stay under the financials, and then real estate's going to become its own GIC sector. Percentage of the REIT index, I'm not quite sure, or percentage of the overall index, I'm not quite sure what it is. The REMS guys might know. It'll be single digits, but it will be something where you're going to have to make a call for or against it. What's been happening that we've noticed anyway is at certain points in the cycle, people are flooding into financials for all the various obvious reasons that the people do that, but they quite often just ignore the REIT space because they can get so much more liquidity and so much more bang for their buck by just investing into the traditional financials. And so the REITs sort of get left alone or ignored. And then there are other points in time where if they have piled into REITs for whatever reason, and then interest rates start going up, REITs become the first name they jump out of because of the heavy dividend concentration. So what we think is going to happen is you're going to get a lot more awareness of the space overall as a diversifier within the equity portfolio realm. You're going to get a lot more demand for listed real estate, which we think probably starts to eliminate some of those discounts on a perpetual basis. I'll tell you, we've been trading at a fairly sizable discount to our underlying net asset value for several years now. Doesn't make much sense why companies would do that, other than there just probably needs to be more liquidity in the space. Third, I think it's going to promote a lot better understanding of the REIT specialty class. There's a lot of nomenclature in the space that most of you probably are not familiar with. For example, we're not measured on NOI or net income. We're measured on what's called funds from operations, which is just really net income adding back depreciation and amortization. It's more of a somewhat of a cash flow measure. But that's just a set of nomenclature that most people have to get familiar with. If they haven't in the past, it can be a little bit daunting. What I think is really going to help is I think it's going to lower correlations between REITs and the other financials. What's been happening is the REITs have been trading just like financials for a long time, and as a result, the big pension fund players, the sovereign wealths, have sort of stayed away from publicly traded REITs because they don't feel like they're getting the diversification benefits of real estate if they buy REITs because they're trading just like financials. So they're saying, well, if I'm just buying a bunch more financials, what am I really getting for that? And as a result, if we start to decouple a little bit from the other financials, we feel like we've got a lot better chance to having an asset class that makes more sense. And then, of course, lower volatility. There's been a lot of, I'll just call it trades into the space and out by the big generalists because of broader moves they have to make. And I think with our own asset class, if you will, they're going to be making those bets based on the underlying fundamentals of the class rather than just trades they're making to move money. And so we think that brings a lot lower volatility to the sector. So we're very excited about this move in August of 16. Let me tell you just a few minutes about Piedmont, and then we'll go to Q&A. Piedmont's one of the larger office REITs in the space. There's 15 to 20 office REITs publicly traded in the United States today. There's a handful that, particularly in the coastal markets, that are fairly large, like a Boston Properties or an SL Green, that are much larger. And then there's a large group of us who are all in that $3 to $5 billion equity market cap range. We would be one of those. Our portfolio is very well diversified, very high quality. We have a fair number of buildings in Atlanta. I'll show you in a moment. Our story today, as we would tell it, is a very substantial upside NOI story as a result of coming out of what was a much tougher time in the real estate marketplace in the early part of this decade. We also happen to have, unfortunately, a very high rollover of our leases during the worst part of the economic cycle. As a result, we felt a fair amount of pain in the 10, 11, 12, 13 time frame. We've now come back out of that, and we have among the highest growth profile in the office space universe today. And we've got a very attractive balance sheet. Portfolio is something you see just a number of the pictures of buildings around the country that we own. We have roughly 70 buildings, a little less than 20 million square feet, a little over 90% leased. First time we've been over 90% leased in about 4 or 5 years. It just gives you a sense of what's been going on in the real estate marketplace in general. Most of our ALR, here's a term you probably most of you haven't seen, annualized lease revenue is a term we use. 77% of that is from our top 7 markets. That would be New York, Boston, Washington, Chicago, Atlanta, Dallas, and Minneapolis, I believe it is. 60% of the ALR, again, the lease revenue is from what we would say CBD or urban infill. And the term CBD is Central Business District, of course. Urban infill would be like a Buckhead or a Cambridge in Massachusetts, or the Roslyn-Ballston corridor outside of Washington, D.C., but buildings that are very close, very hard to replicate because of their infill nature, but they're not really traditionally suburban buildings. We've got about $5.5 billion of total gross assets at a 37% debt to gross assets level, and full regional operating teams in every market. And here's an example of what we got. So you can see our split. We're 23% in the Midwest, 22% in Washington, 23% in the Northeast. So very high quality, very well diversified portfolio. We've made an announcement that 5% in Los Angeles will be being sold off in the first quarter of next year. It'll be getting redeployed probably into Sunbelt markets here in the Southeast. The big story around our company more recently has been a transition of the portfolio. We had a large asset in downtown Chicago, some of you may be familiar with, called Aon Center. Aon Center is an 80-story building, actually the 4th tallest building in the United States, and it was over 2.7 million square feet unto itself. It was literally like owning and managing a city every day of your life. It was a building that was bought before any of our current management team was brought on board, and it's been one of those assets because Chicago has been a little slower to return economically than some of the other markets. It's been one of those sort of anchors to the portfolio for a long time. It's 15% of our income stream in one single building. It had some risk of being a terroristic target, and so as a result, we were sort of always being asked by the analysts in the street, how are you going to address that issue or that drag on your portfolio? And so our answer has always been, we're going to lease it up, we're going to get it to a point where we can maximize the value of the asset and then sell it back into the marketplace. And we were fortunate enough to do that later this year, actually in early November. We closed on the transaction, sold it for several hundred million more than I think anybody thought it was worth. And so it turned out to be a great opportunity for us, But as you can imagine, getting $700 million of proceeds back at one point in time for a company that's only $5 billion in size, there was a lot of use of proceeds challenges. We were fortunately able to meet those by buying back shares at a big discount to our NAV, paying down debt, and then buying a handful of assets, one in Orlando and one here in Atlanta. So that was a great execution from our perspective on that. Our stock has outperformed nicely over the last several months as a result of this execution and the lowering of risk perspective in the company by taking one asset that's 15% of your rent roll and has some risks associated with it that are sort of unusual, and getting rid of that and spreading that diversification across other markets and assets. We like to tell a story that we still think we're one of the best value plays in the marketplace. Here's a lot of reasons why. We feel like we're trading at more attractive metrics than almost any other company in our space, particularly compared to our competitive set. At the same time that we had the lowest rollover of leases now, all the problems we had 3 or 4 or 5 years ago are now becoming other people's problems as their portfolios are starting to roll over. Now, admittedly, at a better time than ours was, but at least we don't have the risk if we turn back down into a recession that we've got a lot of lease rollover coming up. So we feel like we're as well positioned as anybody in our space. And then just for purposes of trying to connect to some of you who may know some buildings in this marketplace, we own a handful here. This is the Airwatch headquarters, also Arby's headquarters there in the central perimeter area across from North Park Central. This is the Galleria 300 building that we bought recently from Brookdale. Here's a Medici building, which is down at the intersection of West Paces Ferry and 75 in the Forum, if you know that building. The Dupree building is along 285 or just east of the river, high quality building that is Superior Essex headquarters. Glenridge Highlands, that's the building that probably most of you know best. It's right in the southwest corner of 400 and 285. It's the taller of those two buildings there. It also happens to be First Data's headquarters building. Johns Creek is a little 4-story building up in Johns Creek that houses one of the finest companies in America, the Piedmont Office Realty Trust. And then Swanee Gateway 1 is an interesting building. It's a building we bought for next to nothing, like $50 a foot back 4 or 5 years ago in Swanee. Some of you may remember it was built on the old Falcons campus site up there. It sat vacant for a long time. We've actually now started having a lot of leasing activity up there finally, and it looks like we're going to fill that up fairly soon. And that's a building that a lot of people said, why in the world did you go way out to Swanee to buy a building and just have to explain to everybody all the time why you're sitting there with an empty building out in Swanee? And the answer is, well, I bought it for $55 a foot, and it's hard to get hurt falling out of the basement window. And so we're going to make a really nice long-term round-trip return on that, but we had to sit with it vacant for a little while to get there. So that gives you a little bit of flavor of Piedmont as well. So hopefully all of that helps your perspective and understanding of real estate and where we are in the cycle. And so I guess now it's time to jump in and do some Q&A. So let me move these things and we'll get to go and doing that.
If we step back and look at asset valuations and in particular cap rates, and for those of you who don't know, a cap rate is just the NOI yield of the real estate asset. Cap rates have come down to very low levels in a lot of markets, which is very concerning. At historic low levels, particularly in the major CBD markets in the US and overseas. How do you view those cap rates at the moment? How sustainable are they? How concerned are you? And how does that impact how you run your business?
Wow, that's a thorough one. Well, it's very hard to generalize when you're talking about cap rates across real estate sectors, but let me do the best I can in answering that. Clearly, cap rates are at historically low levels, and that's, I would say, the great concern. And it's the reason why so many of us are so nervous about buying much product today. In fact, I didn't mention, but we were a big net seller of real estate last year. We anticipate being a big net seller of real estate this year. So, in effect, we're shrinking our company. Just to give you a sense of our nervousness around where values in the real estate market are. At the same time, because we're trading at such a big discount to our underlying net asset value, values would have to fall materially before our company was valued above the value of the underlying real estate. The problem I think we've got in trying to figure out where interest rates or where cap rates and values of real estate are going, get into the whole issue of if interest rates rise, and that's the point I brought up earlier, if interest rates rise dramatically, I think we're going to feel pain in the real estate space just as you would see in any other part of the cycle, and particularly given that assets are trading at such low cap rate yields that as you think about it, if cap rates went from 4 to 5%, that's a huge percentage decline in value of the real estate. Back when cap rates were at 8%, a move from 8 to 9%, the same 1% move is a much smaller impact to the valuation of the real estate. And so I do agree that there's a fair amount of risk in the underlying real estate values, but what you get back to, and which gives you a little bit of comfort, is every building we've bought in the last several years, we've been buying well below what it would cost to reproduce it today. What's happened in real estate in the last few years, and I don't know that this continues, but it seems to be a phenomenon that's been going on for a long time now, is construction costs in all real estate sectors have gone up dramatically. So the same building that would have cost a couple $100 a foot a few years ago to build is probably doubled in the construction cost side. So for example, 300 Galleria building we just bought recently for about $205 a foot. That building all day long costs $325 to $350 a foot to build. Well, I think we can all agree in Atlanta, Galleria is a pretty good office market, a lot of things going on. You can debate whether you want to be near the stadium or not near the stadium, but the point is to reproduce that building today, and we know because they've got plans for potentially building additional buildings in the Galleria at some point in time, it's a good 30 to 40% cost increase to build a comparable building in a comparable location. That gives you a fair amount of comfort that in certain sectors of the real estate market, you've still got a lot of protection if interest rate or cap rates went up. Now, I can't say the same for other certain sectors of the market, and I'm certainly not the expert in other classifications that I am in office, but office is a particularly attractive characteristic in our sector. But if you look at some others, I would tell you that there's assets trading above what it costs to replace them, and that's where I think you get into danger in those sectors. And I tell you, Quentin could tell you a lot more about that than I could in the other sectors.
If you look back to sort of 05, 06, 07, there was a lot of leverage going into commercial real estate, a lot of highly levered buyers, in some cases virtually no equity. The recent deals that you're seeing, how are they different? A lot more equity, and is that highly levered buyer, do they have access to that debt yet?
That's a very appropriate point. We are at a much different point in the cycle. If you deem that we're closer to the peak than the trough in real estate today, which I think everyone would agree with, compared to past cycles, there's nowhere near the lack of discipline from the banking community that we had seen in the past. We have some guys from U.S. Bank here who are lenders to our company, and I think they would, again, probably better experts, subject matter experts than I am on this topic, but we were seeing much higher leverage levels in 2007, much higher leverage levels in 99 and 2000, much higher leverage levels in the late 80s, early 90s at the peak than we are today. And I think that's a function of discipline. It's a function of the public markets having more sway into real estate than we've ever seen before. And so as a result, it's not as if we don't think there isn't still risks in the real estate marketplace, but if there is a major downturn quickly, the impacts aren't quite as great as we've seen in the past.
One of the things you always know when you're at the peak of a cycle, when there's a lot of cranes in the sky. If you look Midtown Atlanta at the moment, there's a lot of cranes in the sky, but I think only one of those is going to be an office development. San Fran, New York City, there are cranes in the sky that are building office. So how do you view this supply cycle as to where we are in the cycle?
Well, again, I'll address office, but I will tell you that obviously the risk is much greater in other asset classes than it is office today, because there isn't the level of office construction, with the exception of a handful of markets around the country. So, as Quentin pointed out, there's cranes almost everywhere. The vast majority of those are in the residential sector. As you drive around, and whether it's Atlanta or Orlando or whatever Sun Belt market you might see, you're going to see almost all those cranes are residential related cranes. You see very little office construction in the Southeast because that market took longer to come back, and as a result, rents haven't grown as fast, and as a result, it would be very hard to build office buildings today at an economic return to the developer that makes sense in a lot of those markets. On the contrary, in places where the markets came back more quickly, like New York, San Francisco, Houston, which is now whipsawed, Dallas, you're seeing a lot of construction. So those places that came back earlier in the cycle have started to see a lot of construction. And as a result, you'll see, because our organization our return, if you will, to normalcy in the valuation side of our business became later in the cycle, that probably reflects the fact that we're in a lot of markets that don't have a lot of construction yet. So as a result, organizations like ours, we think, have a lot longer runway if the market does stay strong, because there's a lot more gap between where our rents are in our portfolios and what it takes to reproduce new buildings in those places. Now, New York, San Francisco, and other places where there is a lot of new construction, I have a little bit more nervousness on that, but it does appear to still be under control compared to previous cycles, so that's the good news.
Do you think the REITs have a big advantage at the moment, just given the access to capital that you have versus, again, back in the early 2000s, whatever, private developers had a lot more access to capital? Do you think that's going to help out for the remainder of this cycle for the REITs?
I would say there are points in time where the REITs have a tremendous competitive advantage over the average private real estate player, and that's largely if you're trading at close to your NAV or better. You've got a much better menu of capital availability. We can go unsecured through the bond market. We can go unsecured through the banks. We can do secured mortgages. We can do a number of different ways to get access to debt capital that the private players don't have access to. And I will tell you, we use those various avenues to our full advantage, because there quite often can be fairly big pricing spread differences between accessing capital in those various segments. So at points in time in the cycle, I would say REITs have a big competitive advantage. There are other points where either we're trading at a discount to NAV, or capital is flowing very aggressively to all sectors where that advantage goes away. But I wouldn't say we're rarely ever at a disadvantage, and that's why I think REITs have performed so well relative to both private real estate and the S&P over long periods of time, is that access to capital is superior to almost any other alternative.
Does anyone have any?
A question on the valuation that you are trading at a discount to NAV right now. Do you think that over the next few months that there is a opportunity for non-REIT players to play in a space which would be typical for REITs to acquire assets? Because REITs can only buy right now at certain valuations or certain cap rates based on where they're trading. What's your view on that?
Let me make sure I understood your question. You're saying, would it be interesting for someone like you to look at REITs today as an investor, or would it be,
like someone like a sovereign wealth fund or like a private equity group that would be typically not look at certain assets because they would be ripe for something what a REIT would acquire. Mm-hmm. But if that capital source is sitting on the sidelines, what sort of opportunity do you think that?
Well, there's plenty of liquidity out there for real estate today. So if you bring a high quality building to market, you're going to get a lot of attention from a variety of sources. In some cases, it may be REITs if they're trading attractively enough. In other cases, it may be private investors, pension funds, sovereign wealth. So, I mean, the menu of investors is long right now, and as a result, private real estate, almost every deal of any quality is getting bid very strongly. What I would say is, if you had to put money into real estate today and you were looking at either the private market as an alternative or the REIT market, particularly in those companies that are trading at a big net asset value discount, to me there's no doubt where the better trade is, because you're buying assets at 85 cents on the dollar instead of 100 cents on the dollar. But a lot of that comes down to what are your goals? Are you willing to live with the volatility of the stock market every day and all those kinds of things? But so it's sort of a different question, I think. Does that answer what you're looking for?
You had on a slide that you guys have 37% debt to total assets. Is that pretty typical for the REIT industry as a whole? That's lower than I would have expected.
It's interesting. The REIT industry, I would say longer term, would typically have been debt to gross assets in the 40s range, low 40s. There's a company called Green Street. For those of you who are not familiar, Green Street's sort of the independent real estate research expert out there, who's been a very strong driver of holding REIT management teams to discipline around leverage levels. And so they would like to see our leverage level in the 20s, to be honest with you. I'm not sure that I agree with how aggressive they are on that issue, but they've really, anytime somebody sort of gets up in that 45 or 50% debt to gross assets range, or a a debt to EBITDA number above sort of 6.5 or 7, they start pounding on them pretty hard and letting them know that they don't agree that that's the right way to run their business. And so that sort of keeps a fair amount of discipline into the public REIT space. I would say that 37% is probably pretty average in our segment of the market, and a debt to gross asset or a debt to EBITDA number around 6.5 would be pretty normal. And we're investment grade, we're triple B, flat with stable outlook, and that we're right in the middle of that set of numbers.
Why did Green Street want to see you so much lower?
Their theory, which I subscribe substantially to, is that because this is a volatile industry, and you go into periods of time where valuations could be impacted dramatically. So, for example, 2008 is a great example. I'll use a company example. SL Green, I'm going to get the numbers off, but you'll understand the point. SL Green was trading at 80 or 90 going into the 2007, 2008 downturn. And in 2007, 2008, they were probably levered at 50-ish%. When you had a major decline in real estate values during that period of time, all of a sudden they're tripping covenants, they're causing problems, and now they've got to go to the equity market and raise a substantial amount of equity at a big discount to their long-term value. And so as a result, the theory is you erode more value in that one decision than all the good that came out of having 10 or 20% more leverage over a long period of time.
And would they say the same to other REITs in your space?
Yes, yeah, very much. They're very consistent. The one thing is they're very consistent about how they apply those principles. Hey, Diane?
The NAV that the REITs get benchmarked off of, is it an accounting number or is it a market value? Is it a market mechanism?
Good question. So NAV is a number that can be subject to a lot of distortion, so you have to be really careful about it. I would say the sell side, by the buy side, I'm not being gratuitous here, the buy side has much better research in the real estate space, particularly around individual company work. And so as a result, we're talking guys like Quentin, you're typically getting they have a much better understanding of what the companies are really worth. Green Street, I'll use a great example. Green Street has our NAV at $23.75. We don't pump $23.75 a share, we trade at $19. I don't comment on our internal NAV, except that we have a bottom-up analysis of our own NAV, which really says, what do we think every building in our portfolio is worth? You add assets, you subtract liabilities, and you've got a sort of a net asset value for the company. In other words, what would it be worth if we were to liquidate it today, if you will? Well, Green Street does a lot of that same work, but it's very bottom-up. I would say the rest of the sell side, and I'm talking about there's 20 or 30 of them out there, they're typically doing an implied cap rate against your income stream, and then so it's a much easier analysis for them to do, but it's also fraught with, if you're off by 10 or 20 basis points, which sometimes they're off by 100 basis points, but they're off by 10 or 20, you're missing the mark on an NAV very dramatically. So where Green Street's got us at $23.75, a lot of the sell side has is at 20 or 21. Well, that's a pretty big difference. And so if you think about it that way, that's why there's so much variability in how this works. And so what I put up there for your was a consensus number, which actually has, for example, our NAV and probably some of our competitors at a much lower number than the group that I think does the best work on that in the space today. Yes, sir.
Is there like a demographic risk longer term to office space, or is that one of the reasons they might be selling at a discount now, just due to a concern about either working from home or aging demographics or whatever?
Yeah, demographics drive real estate across the board, and we could have a couple hour conversation about each segment of the market. And again, Quentin and guys like that could do a better job than I could. But let's talk specifically office. There's been a fairly long view towards office where tenants are getting much more efficient. They're using their space more efficiently. They're putting more bodies per square foot in their space. And so that's been a long-term drag on office real estate. I would say the bigger component of why office is not traded well in the last few years is there's a lot of capital required to go back into buildings to re-tenant space. And as a result, relative to the income streams of some of my peer group in apartments or self-storage or places like that, where the capital per revenue generated is much lower, those businesses should trade, in my opinion, at a higher multiple than office space does, but at times it can be so much dramatically higher that it doesn't make a lot of sense to us. The bigger issue around office space today demographically is sort of that whole thing you read almost constantly about the millennials and how they want to work and where they want to be. And so the things that are really important to us and how we're trying to position our portfolio is making sure we're in places that have walkable amenities, strong parking fields if you need them, space that is attractive to the millennials that most companies are trying to attract into their space. I would tell you, I think most companies have gone way too far in their creation of office space that is so cool that it becomes very non-functional, in my opinion. Now, I'm a fossil, I don't get it. I've heard this all from my younger guys. You don't understand, the world's changing. And then I finally got vindication this weekend because there was a big article in the Washington Post, I believe it was, entitled, "Google Got It Wrong, How the New Wave of Office Space is Actually Ruining Corporate America." Now, I've got justification for a few days until the next article gets written about how cool space is more attractive. But no, what I'm seeing about office space, which I think is going to change again, and this is sort of neither here nor there to this conversation, but it's interesting to me, is you walk into these spaces and people are at bench seating, no backs to their chairs, 5, 6, 7 per 1,000 square feet of space, and guess what? They all got headphones on. They got nowhere to go have a private phone call. And as a result, what you're now hearing is a backlash from some of the millennials who are now coming to find out the millennials are a lot more like the baby boomers than anybody thought based on their preferences and desires. And as a result, what's happening is you're getting some pushback from those environments being almost, yeah, they're cool, yeah, they're fun to be in, but I can't get anything done. And as a result, it's affecting my productivity. And so that's what we're starting to see, and it's interesting how we're starting to now see tenants come back and say, we need to have a blend of space where we have some creative space in the office, but then we have some traditional offices as well. And so now we're seeing build-outs go back to being a little bit more of a hybrid, which is, I think, is probably the right answer.
Yeah.
So it's pretty typical for the major markets to lead out of the cycle. Excuse me, but it seems like the dislocation this time is more severe. And I'd argue that it's probably driven by capital flows that have nothing to do with real estate fundamentals. It has to be more kind of globally where we're at. Do you see this? I mean, in a normal cycle, we would see then people move from major markets to Sunbelt markets to, and the caps would start coming down here. Do you see that playing out the same way in this cycle, or is it different because some of this is yield driven just globally?
Yeah. I mean, I think that's a pretty insightful comment. What often happens in the cycle is the major markets come back first because the capital that's chasing deals wants to go into where they think the less risk is. So they'll go to New York or Washington or Boston or LA. And we were doing the same thing at that point in the cycle. And what we're finding is cap rates move so dramatically to the point where you weren't getting paid to take what is still risk in real estate by going into those markets. So you've seen us be much more aggressive in places where we think there's much more room to run, Atlanta, Orlando, suburban Boston, Dallas, where we saw some opportunities. And I think that is going to be the case again. We're selling out of Los Angeles for that very reason. If you follow regional economics at all, Los Angeles has just had a complete wipeout of their corporate business community. You've still got the entertainment and you've still got some of the other sectors of the economy that are pretty strong there. But if you look at sort of corporate America, they've sort of said, why do I need to be in California? And Toyota and you name the long list of people are all moving to Dallas, Texas. Well, that's why Dallas has got all those cranes building product. And it's also at half the cost with a higher quality of life and better schools. And so you're seeing that very thing play out as we speak. It's almost a blue state to red state phenomenon now as much as anything else, but it's also an issue of sort of high barrier to low barrier or coastal to inland. And that's typical middle, late cycle behavior, and I'm sure it'll reverse itself again at some point in time. But when it's so costly regulatorily and tax-wise to do business in an Illinois or Los Angeles or New York, you're going to have a lot of companies just say, I'm not putting up with that anymore. I don't have to. My employees are portable. Yes, sir.
Don, you said y'all have gone to 85-15 institutional. I'm guessing when y'all came out of the gate a few years ago, it was flip-flopped. How long did it take you? How much of that was index funds and so forth? And I actually have another question to give you a break for our international analyst. And when referencing her question, I thought we were getting to the point before the financial crisis of publishing NAV estimates like the Brits do and so forth. And I think we put all that on hold. Where are we at in that process? And that'll be a lot of fun for you to do that.
I'll try to answer both, and I'll let you give you your perspective on NAV. First question was, sorry, I lost my train of thought. Oh, yeah. Yeah, so you obviously know a little bit of our company. Our formation was as a non-traded REIT where the money was raised through financial advisors in the retail channel, and virtually 100% of our shareholder base was retail. When we did our IPO, if you will, even though we were a publicly registered company with retail investors, we did an IPO to raise capital in 2010 to create liquidity for those shareholders. And literally because we did that and got a lot of following very quickly, we were turned over to about 60% of the portfolio in the first year. So we were down to 40% retail base after 1 year. We're now 5 or 6 years into our public company, and about 15% are still there. So that's why that's how that's happened. But we made a transition much more quickly than most companies have coming out of that space because of when we came out and the fact that we raised capital. The NAV side, I hope it never happens because it introduces enormous amounts of liability to management teams because of the risk of what if you're wrong, and then it also plays into the whole activism and M&A realm where you publish an NAV and now you've got to live with that NAV that you've published, even though market might have moved quickly or otherwise. So I'm praying that never happens because it would be terrible for company managements. But I'm sure he has a different view.
Discounts all around the world, as best I can tell. So, but
I'm sorry?
Around the world, Singapore, Britain, they still tend to trade at discounts, it seems.
It
but
does.
But it's fun to watch. So.
Well, right.
Yeah, I mean, it's all about it's GAAP accounting in the US, and the other market with GAAP accounting is Japan. So you don't have to mark to market your real estate. Your real estate is depreciated through the income statement. So they're the two markets, whereas, yeah, I mean, the UK, Europe, Australia, Hong Kong, Singapore, they all do have a mark to market of their real estate, which is conducted by independent valuers or appraisers, and sort of, you know, updated by the board as well. You know, and I think that different markets trade differently. The UK, for example, trades a lot closer to those NAVs, and if a company comes out with a 10% increase in their NAV, then there's a great positive share price reaction, which isn't the case here in the US because you don't have those NAVs, whereas a market like Australia, the investing community views it as a lagging metric. And so, you know, the sector there is currently trading a large premium. So I think analysts and investors sort of would see through it. I think IFRS accounting is probably better in my view because you do get that mark to market and you can decide what you think the cap rate is, and you've got a very clear number to look at. The other thing here in the US is the income statement where you have the depreciation coming through. So even though the companies put out FFO numbers, a lot of generalist investors will look at EPS and be like, why is this stock trading at a 60 times multiple? It's because of the depreciation. So
Cap rates
I
get
would-
tough in a negative interest rate environment too, don't they?
Sorry?
Cap rates get tough in a negative interest rate on 7 years.
Yeah, that's for, that's for sure.
I'm just looking for you.
I just add one more point to that. You know, my observation, and I've had a lot of involvement with Australian REITs in the past, is there's this unwritten pressure to make sure your NAV looks really good. And to me, that's a really unhealthy environment to be in because there's guys out there who are going to be a lot more aggressive than I am, and I'm going to pay the price for being the conservative guy who's, you know, that's my view anyway, being the conservative guy because I don't want to take the liability of having a number that's too high. And there's a lot of guys who will, and then all of a sudden the market starts, and I just think it can create inefficiencies that you
Yeah, I'm not
you
getting
don't
on the
want.
hot seat. I just thought we put the process on hold here
Right.
as a result of the financial crisis, and I didn't know if it had disappeared.
Convergence of IFRS will eventually drive that, but that's just taken forever now.
It's on
So.
hold.
yeah, I don't know what the timing would be. But
It's my retirement date, as I call it, around the office. Yes.
Should we be concerned about a change in legislation as it relates to the tax advantage of REITs?
You know, it's an interesting question. You know, NAREIT is fairly regularly making sure that we're up on Capitol Hill lobbying. I go once a year to call on people on Capitol Hill to make sure that that's something that they all understand because you know, some people would refer to it as a you know a favorite tax haven for people. It wasn't really ever created to be anything that would benefit the companies that ended up taking advantage of it as much as it was a way to invest, allow the shareholder to the individual shareholder to get access to real estate. And by the way, they're still getting ordinary income tax rates on 90+% of the taxable income. So it's not like the federal government's really losing a whole lot of revenue in theory on that, except for the fact that most of the shares are held by institutional investors. So that's where I think that's where the challenge comes in from a tax policy standpoint. What you have seen, and maybe saw in the Wall Street Journal this morning, and Quentin might be able to address this more readily than I can, but there was out of the House Ways and Means this morning, there was a little issue slipped into a bill that's restoring some tax benefits to some other industries, which again I don't get. But part of that is to try to eliminate companies to do tax or REIT spinoffs. So if you think about it, McDonald's was going to spin off all their real estate into a REIT and get the tax advantage of that and hopefully create more value out of the McDonald's franchise as a result. Well, they're trying to prevent anybody from doing that going forward. I don't know how you do that. How do you prevent them from doing that very easily? But it also seems like it's sort of choosing winners and losers, and I'm not sure why you would do that. Although, frankly, for me, it would be a good thing because there's fewer money in the REIT space, less product in the REIT space. All right, are you familiar with that issue coming out this morning?
It's not clear if the bill will get through or not, but yeah, it's largely about spin-outs, which have been very topical recently. I think maybe we've got time for another question, or
so private equity has been raising a lot of capital lately. More and more funds are out there and are hitting their allocations fairly easily these days. And there's been a lot of activity of private equity taking REITs private because a lot of it has to do with where the REITs are trading today. It makes it a lot more accretive. How do you see that trend continuing, and how does it impact investors who are looking at your REITs to invest in today?
You're right. That is a fairly topical subject, and I'm never sure I know how to address it because movements in pricing relative to NAV take place so quickly that it can take away some of the advantages of those things to happen very rapidly as well. In our space, frankly, in all the real estate space, there's been Blackstone and everyone else, and Blackstone has been by far. Well, yeah, they've done some, but by comparison, they're a small player. And in fact, you add all the other private equity players up together, and I don't think they add close to what Blackstone's done by themselves. And so a little bit becomes it's almost a monopolistic sector right now in terms of how Blackstone's doing it, and they have very specific rules about how they'll go about it, and they won't go hostile, and so they're actually viewed as a very attractive player to potentially link up with and do business with. The problem is if you're trading at a big discount to NAV, they're not going to want to pay the premium you're going to demand, and so they've had to try to find places where the discount's attractive enough that they can make some money on it, but it's not so attractive that they have to pay such a premium that it doesn't make sense to them and to their investors. But I think you're going to see a lot more of them. The consensus view, not my view, the consensus view is office is a much tougher sector to get those things done in, and that's why you haven't seen any in office. But that doesn't mean there won't be. Would you add anything to that?
Yeah, I mean, the issue with the REITs is there's so many social issues, corporate governance issues as well. It is very hard to go hostile against the REIT, and then there's the 10% ownership cap as well. So Blackstone, I think, have been very clever in the way they've done it. But there was another office REIT who basically went public with a process to sell themselves recently, or seek alternatives, and nothing's happened yet. So,
and it doesn't appear that there will be anything happen anytime soon. That's a great example of why people think it's unlikely to happen in office anytime soon, because we had a real life example of someone try, and they sort of didn't have anybody show up at the pricing they were looking for. Thank you. Appreciate it.